A new rule change from the SEC should make fundraising a lot easier for 506c funds. So, what is this new guidance, and what exactly does it mean for private funds, real estate syndications, and investors? I'm going to break it all down for you next. Now, Reg D Rule 506c really revolutionized the alternative investment industry by allowing private funds and real estate syndicators to advertise their offerings and raise money directly from high net worth accredited investors. And this new rule was first brought about in 2012. But the downside was that each investor's accredited investor status had to be manually verified. This process could prove tedious and was a bit invasive as well. Sometimes an investor, a new LP, writing a check for a sponsor didn't necessarily want to share bank statements or a letter from a CPA. But now this is all changing. We just received brand new guidance from the SEC that is going to make this process much easier for a lot of private funds and real estate syndications. And it's all right here in this SEC no action letter. I'm going to get to it in a moment. On today's episode of Fund Playbook, I'm going to break it all down for you. Plus, I'll tell you my key takeaways from this brand new March 2025 rule change. Welcome to Fund Playbook, a show that's all about how to launch and raise capital for your very own private fund or real estate syndication. I go live every Thursday at 3 p.m. Eastern Time. Just hit that subscribe button to follow the show. I'm your host, Jimmy Atkinson, here on Monday, March 17th, with a bonus breaking news episode of Fund Playbook. So we just received this SEC rule change from dated March 12th, 2025. It's not a rule change so much as it is a new interpretation of an existing rule. But to explain this change, first I want to define a few terms. For instance, let's talk about Reg D Rule 506c. We broke this all down in a recent YouTube video on our channel. What is Reg D Rule 506c? And I'll just kind of share it on the screen right now. This episode of Fund Playbook we shared just about a week and a half ago. You can see on the screen there some of the requirements to be a Rule 506c fund. And requirement number 2 is verification. Well, the verification rule is changing. So you do still need accredited investors only in a Reg D 506c fund, but the verification is completely changing. So to rewind though, Reg D dates back to 1933, the Securities Act of 1933, and it was really designed to protect the investor in offerings that were not registered and made public through the stock market with the SEC. Previously, here's how things worked with Rule 506c, was that 506c was introduced in 2012, and it allowed private funds for the first time to publicly advertise their offerings to the general public. But the catch was, in order to have investors invest in your offering, whether it was a VC fund or a private equity fund or a real estate syndication, the sponsor of the fund, the issuer of the fund, the manager of the fund, the syndicator had to verify the accredited investor status of every single investor that came in. That's how it was prior to just a few days ago. Well, now the SEC has said, and I'm going to share it on my screen right now so I can just actually walk you through exactly what the letter says, because it's really crucial what's happened here with this letter, is that they are saying that you still need to have accredited investors only in a Rule 506c fund. But a letter that was sent to the SEC by the law firm Latham and Watkins earlier this month on March 6th, the SEC got back to them last week, and it says explicitly, this is from the SEC, we agree that a high minimum investment amount is a relevant factor in verifying accredited investor status. And they go on to say a little bit more about that. Specifically, in this particular case, a minimum investment amount of $200,000 is sufficient to qualify as an accredited investor. Okay, so first of all, what is an accredited investor? For those who don't know, for those who may be new to the channel or new to this topic, an accredited investor is any individual who has a net worth of at least $1 million, not including their primary residence, or an individual who earns at least $200,000 a year or $300,000 a year if jointly with a spouse. Now, there's a few other ways you can qualify as an accredited investor. You can hold a Series 7 or a Series 65 or a Series 82 license. You can be an LLC with at least $5 million in investable assets. You can be an LLC where all the partners are accredited investors. There's a few other ways, but by and large, for most LPs that are investing into private funds or real estate syndications, in order to qualify as an accredited investor, it essentially means you have $1 million of net worth, excluding your primary residence, or you have annual income of at least $200,000. But now the SEC has, and previously what you had to do as a Rule 506c fund was, before you took in investment dollars or as you were taking in investment dollars from an LP, you had to have them verify their accredited investor status through a third party. Usually they would send you a bank statement that showed their net worth, or maybe a pay stub from their employer that showed their annual income or tax returns from the previous couple of years, or a letter from a CPA or a letter from an attorney. A little bit invasive, a little bit of friction that was introduced, just another hoop that LPs had to jump through to invest into private investment offerings. Well, now for funds that have a minimum investment of $200,000, if you have a fund with a $200,000 minimum, maybe it's $250,000, maybe it's $1 million, you don't need to require that your investors do that. The SEC staff from this division is now saying, look, that's enough. That's enough to reasonably assume, if somebody's writing you a check for $200,000, it's reasonable to assume that they are an accredited investor. So what does this mean exactly, though? Well, by the way, for those watching the live stream right now, if you have a question for me, we are live. Please submit it using the chat feature on YouTube. I'm going to be addressing your live questions a bit later in the show. But here's my 3 takeaways from this news. First takeaway is it's going to be much easier to raise capital as a Rule 506c exempt offering sponsor. For all the reasons I just mentioned, there's just fewer hoops for LPs to jump through. There's less friction. Part of the subscription process for the sister of a 506c fund is the 506b fund. Those funds, you cannot do any advertising directly to high net worth accredited investors. All of your investors have to come in through pre-existing relationships. And for the most part, they all have to be accredited investors, although there is an exception. Up to 35 non-accredited investors can come in. But with a 506b fund, you don't have to verify the accredited investor status. And so, it's a little bit easier, particularly if you have a pre-existing relationship with somebody. 506bs can be a little bit easier than the 506c because you don't have to have the investors jump through additional hoops. Well, now those hoops don't exist so long as your minimum investment at least hits that $200,000 amount. So I think it's going to be easier to raise capital in that regard. There's just one less hoop to jump through, a little bit less friction. Takeaway number 2, I love that this bright line test is just so much more clear, because they're taking reasonable steps to verify the accredited investor status of every investor. It was a little bit iffy in how you interpret that. So now this no action letter from this SEC division staff clearly states, look, if the minimum investment is $200,000, then you don't need to do anything else. We can assume that they are accredited. And what this interpretation signals is really, in my mind, just a more friendly approach from the SEC going forward. And perhaps there's more changes to come. They have made some changes in recent years. As recently as the end of 2020, they broadened the accredited investor definition to include more types of investors. They didn't change the numbers on the individual investors. It's been $200,000 annual income and $1 million net worth, not including primary residence, since I believe the 1980s. That didn't change, but they broadened the scope of who else can qualify. Key members of a fund, GPs in a fund, employees of the fund who have key information, all of those people now qualify as accredited investors with respect to that particular offering, meaning that, look, if you're a GP in this deal, or if you're a staff member of a GP in this deal, you can participate in this deal as well with your own money. We count you as an accredited investor, even if you don't meet the traditional definition. They expanded it to include folks who hold Series 7, Series 65, and Series 82 certifications. And then they also expanded the entity definition. If you're an LLC or other type of entity with at least $5 million of investable assets, or all of your partners and members are accredited investors, either one of those will qualify as well. So they broadened that. So I think what we've seen from SEC enforcement, SEC interpretation over the last few years, and continuing just late last week with this new interpretation letter, just a more friendly approach from the Securities and Exchange Commission in general. So takeaway number one, I think it's going to be easier to raise capital. Takeaway number two, love this new bright line test, and I think it just signals a more friendly approach from the SEC. And then interpretation number three, I think this is going to accelerate the shift from 506B to 506C. Now, let me explain what I mean by that. And then again, by the way, this no action letter essentially removes the verification requirement if certain conditions are met for 506C funds. 506C funds no longer have to manually verify from a third party the accredited investor status of investors in a fund or syndication, so long as the fund's minimum investment hits $200,000 or more. Also, I failed to mention before, the investor essentially at that point in time can just self-certify or attest on his or her own that he or she is an accredited investor. So I think the whole, for the past few years, I've been talking about how great Rule 506C is, but I would admit that the 506B is a little bit easier for ongoing compliance and for onboarding investors. What made Rule 506C great, and what still makes Rule 506C great, is that you can advertise your deal. You can advertise your real estate syndication. You can advertise your private equity fund, whatever it was, whatever type of private exempt investment offering that you're offering to investors, you can advertise it now for the first time ever as of 2012, when Barack Obama signed the Jobs Act into law. Prior to 2012, you couldn't do this at all. You couldn't advertise a private deal at all. You had to register publicly with the SEC in order to do any of that stuff through an IPO. And that's a whole nother cumbersome process that goes beyond the scope of this video. But Rule 506C really started democratizing access to alternative investments, to real estate syndications, to other types of private funds. But the one catch was it's a little bit more cumbersome because you have to verify the accreditation status of every single investor coming in. Well, now I think, and that was oftentimes given as a reason for sponsors that I've worked with in the past. Some of my clients, I would ask them if they were 506Bs, hey, why are you still a 506B? Why don't you go the 506C route? You can advertise directly to sponsors. And there's a few different reasons, but one of the reasons why a lot of issuers kept issuing new funds and new offerings as 506B, as opposed to going 506C, was that cumbersome step of having to verify the accredited investor status of every single investor that comes in. So I think this may accelerate that shift from 506B to 506C. It's been part of a shift that we've seen beginning in 2012 and really starting to accelerate here in the last, I'd say, 5 to 7 years. And I think this might be another inflection point in that evolution, moving from the old way of doing things to the newer, more democratized way of doing things. This rule from the SEC really will open up a lot of capital raising, I think. So once again, if you have any questions, don't hesitate to ask in the YouTube chat. I'm going to answer some live questions right now. Let's see what we have here. Got a comment here from Diana. She says, "Hi, everybody, and thanks for covering this show. Jimmy, love the show." Thanks, Diana. Thanks for being here today. Let's see. We've got a comment here from Central Commercial Group who asked, Jimmy, do you think this new ruling has anything to do with this new administration and their strong favor for OZs? So that's a great point that this person brings up. OZs meaning opportunity zones. For those who aren't part of my opportunity zones community, opportunity zones, a relatively new tax advantaged investing platform that was introduced by the Trump administration during Trump's first term in office as part of the 2017 Tax Cuts and Jobs Act. Essentially gives the tax advantages for rolling over capital gains into low-income communities and projects undergoing development in those low-income communities. I don't know specifically that this has anything to do with opportunity zones, although it will apply to opportunity zones, but more, I think it just signals, like I mentioned a moment ago, just this ongoing, more open, more friendly environment from the SEC that actually got started, I think, before Trump took office and is continuing now during Trump's second term. I do think we're just going to see a more friendly SEC and its interpretation to some of these rules that have been on the books for, in some cases, years or decades or nearly a century. The Securities Act of 1933 goes back almost 100 years now. They do seem to be interpreting and revising these rules just in more friendly status, more friendly to issuers or fund managers, and also more friendly to investors in the sense that they're going to allow a broader group of investors to participate in these types of funds. A little bit less restrictive, a little bit less regulatory, I guess. All right, a couple questions here from Connie. Connie wants to know, do the lawyers on this call think it is still prudent to get the certification of accreditation? So Connie, I would say yes, but I think that and I'm not an attorney, so I would love it if any attorneys who are watching now would weigh in on this. But this no action letter suggests that, let's see. We note that your representation that the minimum investment amount would be accompanied by written representations from the purchaser or investor. Let's see. Yeah, so what it's basically saying here is that they still need an attestation or self-certification from the investor that he or she is an accredited investor. So I think you might still need to get something. But what you can short circuit is, it no longer needs to be a third party verification. It no longer needs to be a bank statement or a letter from a CPA or anything else that's invasive and just requires one more hoop. Okay, so Connie says, so with this private letter ruling, can we accept a $100,000 investment so long as for that investor, we get certification for that investor? So the bright line test, Connie, in this particular instance is a $200,000 minimum, definitely meets the test. One other note that I'd like to make, though, is that there were also some compliance. There was a compliance interpretation that was issued as well. And I'm going to see if I can pull that up on my screen because I want to read through that with you right now. Let me see if I can find that here. So this is a compliance and disclosure interpretation. I did find it. I'm going to put it up on the screen right now. In addition to this private letter ruling or this no action letter, there's compliance and disclosure interpretation from March 12th. And specifically, I'm looking for, let's see, it's question 256.35 and 256.36. We click here. This says, if an issuer does not satisfy any of the verification safe harbors, are there other methods that will satisfy the requirement to take reasonable steps to verify accredited investor status? So this all boils down to taking reasonable steps to verify accreditation status. And so that part of the rule hasn't changed, but the interpretation of the rule has become a little bit more clear now. So it states here, and this is the key line, I think, the list of methods of verification in Rule 506C, paragraph 2, subparagraph 2, are non-exclusive and non-mandatory. So if we look up this rule, there's a variety of methods of verification. I rattled a lot of them off, right? Let me see if I can find this. Verification of accredited investor status. Let's see here. Where does it say this here? Taking reasonable steps to verify that purchasers of securities sold. Take reasonable steps to verify. Let's see. Oh, here we go. In regards to whether the purchaser is an accredited investor on the basis of income, reviewing any IRS form, Form W-2, so that's a pay stub, Form 1099, Schedule K-1. In regard to whether the purchaser is an accredited investor on the basis of net worth, they need to see bank statements, brokerage statements, other statements of securities holding, CDs, tax assessments, appraisal reports issued by independent third parties. So this list right here, we're obtaining written confirmation from one or more persons, such as a registered broker-dealer or an investment advisor or a licensed attorney or a CPA. So I rattled off some of these lists. What the SEC is saying here, Connie, is that all of those methods listed in that part of the rule are non-exclusive and non-mandatory. So there can be verification steps that you can take that are not included in that rule. So for instance, if in the case specifically of a $200,000 investment, and I think this is covered here in this clarification, question 256.36, an issuer is conducting a Rule 506C offering where each accredited investor is required to make high minimum investment in cash. Do the terms of the offering, in particular the minimum investment amounts, satisfy the reasonable steps? So let's see. This whole thing basically says yes here, and refer to this letter that I'm holding up here. And then at some point it does list $200,000 specifically. Let me see if I can find that. Let's see. I think that might be in the letter itself. I don't remember where the 200,000 came from. Anyways, Connie, with the $100,000 investment, that doesn't quite meet the bright line test, but there is a little bit more flexibility. That's for sure. Okay, Connie does say, haha, don't ever interpret the SEC as friendly. Connie, good point. I guess I would say they're becoming more friendly, but maybe they're not friendly yet. Connie says, thanks, Jimmy. Thank you, Connie. Okay. Jose says, is there a higher minimum dollar investment for entities versus individuals? Jose, yes, it did mention in here that for individuals, the bright line test is $200,000, but for entities, it's $1 million. And forgive me, I've lost exactly where that is. There was quite a bit of language floating around here. I want to see if maybe it's in this article that I was reading before from Crowd Fund Insider. So yes, the Latham no action letter actually specifically states the high minimum investment amounts. So let me see if I can find that. So I think, here we go. It's the incoming letter from Latham Watkins that lays out the specific circumstance. So the proposed interpretation right here from Latham Watkins shows that what they're asking the SEC is to agree with their conclusion of what would be reasonable steps to verify a purchaser's accredited investor status. If the issuer obtains written representations that the purchaser is an accredited investor and that the purchaser is not financing the investment in any way, and that the minimum investment amounts are at least $200,000 for natural persons and at least $1 million for legal entities. So there we go. I found where it was. It was in the incoming letter. This was sent in from Latham Watkins on March 6th, and the SEC got back to them here. This is their private letter ruling here, the no action letter that came in late last week that we're dissecting right now. Let's see. I don't see if there are any other questions or comments. Thanks for bearing with me here as we kind of put this episode together just today. So it's kind of a rushed episode, but we had fun putting this on. I think this is really big news for the industry. I think it makes 506Cs a lot more flexible for issuers and for investors also, right? If you're an LP, it's kind of a pain in the butt to go get your accredited investor status verified. I got to show you my bank statement, or I got to get a letter from my CPA. Little bit of a pain, but and then for issuers, makes that subscription process more closely aligned with a 506B subscription process, which is a little bit more streamlined, a little bit less friction. Got a couple more comments here from Connie. Really appreciate you coming in here today, Connie. Connie's great. Connie Rathbone, by the way, she's a securities attorney based in Boise, Idaho, and she's a member of our mastermind group at OZ Insiders. So really like getting her interpretations. She says, so it sounds like the standard now is that if you have a $200,000 minimum, then it is the self-certification like we have always used with 506B. Connie, that's how I'm reading it. Yes, I think that's exactly right. It's essentially the same as 506B if you're getting in a $200,000 check or higher. Now, who does this not apply to? So I think if you're still getting in checks in the 50K range or the 100K range, somewhere in that amount, you're probably still going to want to get that accredited investor status verified by a third party, just like you would normally with Rule 506C. But otherwise, yeah, if you're 200K and above, it looks like this new interpretation from the Division of Corporation Finance at the SEC makes pretty clear that it's a new test, 200K. Okay, let's see. Connie also says, but if it is less than that, you can do a self-certification, but with issuer due diligence. Yes, exactly. I think that's exactly right. Anyways, yeah, thanks everybody for attending today. Really appreciate all of you who were attending live, and thanks for all the great questions and comments. We're out of time. We had a lot of fun putting this episode together today, kind of a rush job. We just started putting this together a few hours ago, sent out the emails, and pleased to see all of the attendance that we've gotten today. Our next episode and live stream on YouTube will be this Thursday at 3 p.m. Eastern time. You're invited to attend the live stream and ask your questions about starting a fund or real estate syndications, that I can answer your questions in real time. And please be sure to subscribe to us on YouTube. And if you like today's episode, hit that thumbs up button here on YouTube if you enjoyed the show. By the way, Fund Playbook is now also available on Apple Podcasts and Spotify. Just search for Fund Playbook on the app. You can also visit fundplaybook.com and click the Apple or Spotify button. Thanks for watching and listening. I'll be back on Thursday with another episode.